So I do a mic check. Testing 1 2. Testing 1 2. Testing 1 2. Just want to make sure everyone can hear me okay. We'll get started in a little bit. All right, hello everyone. I'm John Slazas from Dharma Capital Trading. Been involved in trading crypto since 2013 and been involved in the markets pretty much my whole career. I'm from Chicago, and my first job was on the floor of the Mercantile Exchange as a kind of summer job as a runner. I was also into racquetball back then. That was kind of really what I was focused on. But then went away to school, and I knew that the only way I was going to learn about trading was down on the floor. So my sophomore year, after my sophomore year, I moved back to Chicago and started going to night school at DePaul and working on the exchange all day. I was fortunate enough to fall in with some good traders. Actually through racquetball, one of my first jobs was with a local pit trader. And we met through racquetball, and typically on the exchanges, it's really a family business. Where you definitely need to know somebody. So outsiders don't really get in, and so I got along well. We used to play together, and then he knew I had experience down there, so he hired me as his pit clerk, and then my job was basically to count his cards, make sure his position was okay, and then keep charts for him. And so, he kind of directed me with some technical analysis tools, and I took it from there. Lots of long days and nights studying in the Merc library, and then just asking questions to anyone who would answer them. And got to the point where my job for him was to basically write numbers down on a card and say, here's where we want to get into the market. And then his buddies wanted to see those cards, and so I started making copies of those cards, literally handwritten. And then more people wanted it, and so then I started Xeroxing them, and kind of that's how I started my analytics business. Really just selling numbers on the trading floor. And so and the methods that were used are basically still valid today, and they're all based on market truths and what traders have been doing for years. And so we're want to show some of that to you today as well. And these tools are dynamic to help you do many things, but the thing we're going to talk about today is size management, which is one of the most important things for trading. You cannot always have the same size of your trade. You have to differentiate, even if it's just a 1 or a 2, 1 unit or 2 units. You have to differentiate between the value of an opportunity. And that's what we're going to talk about today. Wait for a couple more minute here. We'll get into it. One thing before we get started, I want to go over a disclaimer. I mean, basically, everything we're going over here is educational. If trading has lots of risks, so if you're involved in trading, you want to use risk capital. It's hard to have a clear mindset without it. If you have to be in a situation that you have to make money on this capital, it's going to be too overwhelming for you to make good decisions in the moment when you need to. Even any hesitation is going to be a detriment to you. So we're here to give you some insight to help improve your trading. We're not making recommendations, but we're giving you some facts and tools that you can use to create a sustainable trading career. And by doing that, you need to have some risk capital. And if you don't have risk capital, there are opportunities to have people fund you. And so that's and these are the tools that can help you get funded. And if that's something that you're interested in, definitely send us an email and reach out to us, and we can kind of help you, direct you with that. We get a lot of clients that are taking these performance challenges, so absolutely, working with people to succeed through that is something that we are definitely doing. So reach out with that. So today we're talking about size management. Let me test. Everyone hear me okay? I want to make sure my audio is all right. Yeah, I've got my audio going on the machine. I don't see the... Hold on one second. Okay, great. All right, here we go. So, size management, it's a backbone of your business plan. Trading's a business, and you need to make sure that, when you're trading when the odds are in your favor. Simple as that. And having effective size management, that's how you're going to, achieve sustainable profitability. And that's what it's all about. It's not about, if you're in the trading to, just to hit the lotto, that's not what trading's about. Trading's about consistency. Being consistent and being consistent in how you put your capital at risk is key. How do you, striking the balance between returns and risk, that's really the essence of size management. You've got, trading is an art form. Quantitative trading and intuitive function, they both require precision. You need to fine-tune both. And so, having a baseline, a quantitative analysis or facts, specific facts, and then with those facts, giving you better intuitive insight, which you can improve on with your experience. So you need both. You need a fact baseline. You need a benchmark to lean on, so that your emotions don't get the best of you. And so then when you are in the moment and making decisions, and you're making those decisions intuitively, you're making it within the guidelines of what the fact foundation is. So as you're in your trading decision-making process, for successful trading, you have your strategy or your mandate. I'm a buyer, I'm a seller. And it gives you your direction. And then you have your tactics and your discipline. And if you don't have discipline, you're not going anywhere. So you have and then with your discipline, your tactics to execute your strategy, you have a risk management safeguards. You know where you're out. You're either using hard stops, or you're on top of the market with your finger on the trigger, protecting your position, protecting unrealized gains. And so those are all major pillars of trading, and the one that really makes you take it to the next level and differentiate from everything is your size management. This is really your upside. This is your potential. You have to hit it big when it's time to hit it big, and you have to back off or not even trade when it's not time to do it. It's important to understand, every time you're putting capital at risk, it's all about probabilities. You need to understand, what's the value of this opportunity? And what do I want to risk to get that opportunity? And so your size management needs to match these odds. And a simple way to do that is, definitely the way we look at the market is, we're adding leverage in the markets in alignment, and we're deleveraging when it's out of alignment. And we'll get in a little more into that later, but basically, if you have a situation where you have to risk 1%, and you can make 2%, that's not bad. I prefer to make 5%, but you don't want to be in a situation where you're risking 1% to make 1%, or risk 1% to make 0.5%. I'm sure you can do a lot of back testing on studies that they make a lot of money for a long period of time, risking a lot and making a little, but all of a sudden that strategy doesn't work, and then you blow your account out. So it's not sustainable. And that's the goal. The goal isn't having sporadic large gains, but steady growth. And by having proper size management, that diminishes the risk of getting killed. Ideally, if you have to risk a lot, then you should have lower size on. Maybe your emotions are getting you into the market sooner than you should be. So get in. If you have to get in, get in. I'm a big fan of participating in the market. If you want to be long, get long. But just get a test in, or potentially put an option spread on, something light, until the market comes into alignment, and then you can hit it. And and having a process so you're building consistent gains, and you just accumulating alpha, accumulating profits. One of the biggest issues of improper size management is how it affects your emotions. And really they can just totally take over and have you make, impulsive decisions. And this really comes from just being over leveraged, because it amplifies your fear and your greed. When you come in and you put a number on, or you go big because you have a feeling, or there's you have your ultimate signal that's generated, and you're over leveraged because in the bigger picture, it's counter to what's more likely to occur. But at the moment, there's you have this big signal, and then all of a sudden, you just see the money coming in because the markets are going your way, and it's just like, wow, this thing is just going to go big, and I am just going to have a monster month. And you're not thinking clearly because you're blinded by greed. And then all of a sudden, that breakout doesn't follow through. The market turns and just immediately puts you in the negative, and then that leverage is against you. And then you're fearful, and you hesitate. And in crypto, if you hesitate, you're out. It's so fast. And all of a sudden, you're really in a situation and you freeze. And then you're just hoping. And basically just making one bad decision after the next. And typically more likely what happens, the market's just going to keep searching and searching for that stress point until you puke out of whatever you have. And you're even being in blind of where you're doing that, and then the typical reaction is the market stabilizes and comes back, and you had the right signal, and you just got caught up in a squeeze, and you made bad decisions because you're over leveraged. So it's a simple thing to keep in mind is just your risk reward ratio. Ideally putting yourself in a situation of 1 to 3. I'm going to risk 1 to make 3. It's a kind of a guiding rule. And if you're not in that situation, you need to understand that you're at more risk. And you definitely want to be smaller. It just doesn't make sense. And you need to be more active and aggressive with your size management. I just saw someone talking about win rates. Who cares about win rates? I know a lot of people that had incredible win rates. There's a lot of the options traders on the floor, would just pick up, they were talking about, picking up dimes in front of a steamroller. They're just money every day. It was just money. I'm just, just selling vol, and I'm making a little bit, and then one day it's just bam, and they blow their account out. Versus, as Fooled by Randomness by Talib talks about, the harder thing to do is lose a little, bam, make it big. Psychologically, it's easy to sit there and you feel good about yourself. Oh, I made money today. And you have, 20 days of making money in a row, 30 days. And then you have one day that you lose. But that one day wipes out all those 30 days. And then some. Psychologically, it's easier to handle that one terrible event because you feel good about it for the whole month. Versus taking little losses, being patient, staying in alignment, and then letting your profits run when you get involved in a trade with the proper size and you hit it real big. I've always been a big fan of the Sortino ratio versus the Sharpe ratio for that fact. How much are you risking for what you're looking to make? other just basic facts to to keep in the in the front of your mind is, how are you dealing with market volatility? And when economic figures are coming out, when other markets are having significant moves which might influence the market that you're trading, it causes these aberrations, and especially in crypto. With thin markets, you can get some crazy swings. And crypto doesn't trade like other markets, and you have to think of crypto more as a seismograph. A lot of the tools that traditional markets think, most people think work, definitely don't apply in the crypto markets. And so you can have these big squeezes and swings in crypto, and you need to, when markets kind of shift into that mode, you need to dial your leverage back. And the good thing about that is, one, it keeps you centered, keeps you focused, keeps your emotions calm. And then when the market does get out of alignment and does set up, comes into an alignment area that has a good risk reward ratio, 1.5, 1.8. Then you can hit it a little bit because your risk. You've got the market's got the volatility, but you know what your risk is, and it's got the potential for a big payout. And so even in big volatile situations, you stick to you don't widen your stops. I like to keep them tighter. I'll just get back in, and then it's like, okay, you stop me out, fine. Now it's back. I'm in. Stop out. I'll do that maybe a couple times, and then I'll just give up. And then I'll just give up on it, and I won't. I won't press it. But otherwise it's like, okay, you got me. Now you should just go. If you don't go, then I'm out. And if you do, that's my story. I'm sticking to it. Typically when the market goes to, and those are opportunities that happen at extremes. And the market's either going to break structure and go, and if it doesn't, it could reverse. And everyone that's got caught on that, you should revert the other way and just go. And if it doesn't, it doesn't. There's no hoping. Just it is what it is. But bottom line is having the proper risk-reward ratio, staying light until the market's in alignment, especially when the market volatility picks up. Then you have that awareness and you've got the opportunity to take advantage of those. So, just in a general sense, having effective size management is going to give you this resilience. It's going to give you that peace. And you need to be centered and peaceful to trade intuitively and focused. And that's going to lead to more sustainable growth and a prosperous career. I mean, if you're going to get started, if you're going to maintain your trading over a long term, you're going to need to you need to have really a standardized way to manage your size management. And to do that, you need a benchmark. You need a statistical baseline. You need objective facts and tools that can give you some clarity to your emotion. It's easy to get anchored by, you hear some news, someone says something, and you get stuck on something, and always having kind of a check, something to a baseline to kind of check yourself. And without it, your subjective opinions are going to influence you, and they're going to make you. End of the day, they're going to make you hesitate. And if you hesitate, you're going to lose money. So I'm going to show you some of our tools, as a solution to standardize your size management. And you can do this, some of this stuff, you can search out and create your fact foundations. We've done that with our playbook, which really defines the main components that you need to be aware of to identify if are the odds in your favor, what's more likely to occur. That's a great phrase to keep in the back of your head. What's more likely to occur, and that's like a mantra. You could tape that to your monitor, because that's what it's about. Every trade is based on odds and what's more likely to occur, and what are things that we need to know. And I'll go through this, and we'll take a look at some live examples, and we'll take a look at kind of the microstructure and what's happening currently. But you need to understand what the state of the market is. So whatever tools that you use to define, is the market trending or not trending, basically what's the context of the state, and really taking ownership of what that means. And if you don't have that, we definitely have can support you with that. An objective, quantitative result that defines this is what is true, this is what the state is. But not only, not just and you really need to own that environment. So just saying something's non-trending is one thing. What does that really mean? What are those expectations? What tactics do I have, or trading styles or methods that I use that will work best in this environment? And if you are, a trend follow through, you're looking for follow through and breakouts, and in momentum trades, you need to be super careful in this environment, and you need to trade small until this environment changes, because market states are always changing from one state to the next. But what's the foundation? If that doesn't align, trending, non-trending market states like neutral digestion don't align with trend following strategies. Absolutely, markets transition from a neutral digestive state into a trend state. That's how, when they transition, that's what they do. But it's hope until they break structure, and that's when those systems don't work, and that's when you get chopped up in those systems. So altering your tactics, and if you don't have any of those tactics, then don't trade it. And if you do, then switch tactics to mean reversion, fading momentum. But owning the state is key. You need to understand what you're dealing with. And once you understand what the state is, you need to define the structure of it. Where does that state change? What is the price structure of that state? At what point is this state no longer digesting? At what, that's those key inflection points. That's where the best opportunity is. That's where the risk reward is best defined. Anywhere else in the middle is expensive, and that's exactly where all the predatory algos live that are looking to take your money on these mindless, choppy moves that don't mean anything, and they're just there to press the buttons of emotions to get people to puke out of their trades that are good trades. So this is where the alignment comes in. What are those price boundaries that define the state? Everything that you do should zero down to if-then statements, because then you can't have that subjectivity in the moment when you need to make a trading decision. You need to know, if this does this, then if this happens, then I do this. And then it's about the awareness of the condition. Is it working? And then you have a better benchmark of, yeah, it's working, or no, it's not working. And if it's not working, you need to be careful and tighten up your risk. If it is working, you need to let it go and let it pay you. So with the playbook, we're identifying what the state is. We didn't identify the structure of the state, and we identify the bias of that structure, and from that, it's an if-then statement. If it's in this structure with this structure bias, if it's in this state with this structure bias, this is what you do. And today I've got the Bitcoin example up, and we're going to take a look at Bitcoin today, right now. but basically identifying this where are we at. So let's just go into the live market and see what's happening here in Bitcoin. Structurally, there's what I showed you on the playbook. I'll pull it back up. Is a daily time frame, but the structure. There's weekly structure. There's monthly structure. It all depends on what your focus is. But the daily structure is a nice pure structure, and so we're going to focus on that today. Something that I've gone over before in previous presentations is time frame structure. And so this is really overlooked, but it is absolutely what all the large funds traders look at, because it's based on mark to market of their P&L and their performance. And it's just identifying what is the even just like the previous close, the previous day's close, the previous week's close. Absolutely, the previous month's close is huge. Previous quarter, previous year, is the market up or down on the year? I mean, you should know that, and so definitely those are key price points. So if we're just talking about the daily structure right now. Yeah, you always need to know what the previous day's high is and the previous day's low. And you need to understand the previous day's close. So these are just some basic facts that just this alone you can use for your size management. Another great metric is the midpoint. It's kind of like it basically is the previous day's midpoint, or VWAP. And the current session VWAP is important, because all the big funds are looking at that too. That's where they're primarily trading. So if simple rules of thumb. Hey, if the market's above the previous day's high and you're short, you need to think about that. And definitely it should be a rule that if I'm ever short above the previous day's high, I trade my smaller size. If I'm short below the previous day's low, I trade bigger size. Simple as that. That's a rule. And you can just add to that on your size. If I'm above the previous day's close, you can kind of lead into that opportunity. Or if I'm above the previous day's midpoint, all these things add up. It's also the market telling you what it wants to do. Simple tool. And looking at that on a weekly basis, a monthly basis, those are all facts you need to know. So here in Bitcoin today, this is the start of the session, basically using 12 a.m. UTC time. And we get a close. Market immediately takes out the previous day's high. And here's what's interesting too, and how and why this is like as a technician, what are you looking at? You're looking at this peak here is more important, right? This is the resistance. But the market's not looking at that. So the market likes this. One of the things it's looking at is the previous day's high point, which is here, which happened right at the open, previous day's open. And it's also keying off of this close, this whole band here. You got to, and these tells here are signs of strength that foreshadowed this. And the fact that we couldn't retest the midpoint is also kind of a sign of strength. So that's just a basic fact-based tool that you can integrate immediately into your program to help you with standardizing your size management. So with the playbook, so we have, that's one tool. So now all of a sudden, we have our daily time frame structure done. Now we're looking at what's the state of the market. Well, the state of the market is that we are in a neutral digestive state. Okay. Let's move this over here. So just defining that start of the session. So we, in the previous presentations, we've talked about price discovery and how the market creates ranges during this, has specific behavior during the settlement period and specific behavior during the opening period. And so the opening period, the market, is basically, you've got new people are coming in, the margin rolls over. Not so much in crypto as in legacy markets where it's more pronounced, but you've got new entrants coming in at that time, and so you do definitely get some play during the start of a trade period, and with the expectation that, hey, this market may have some issues. It may be ready for more sideways action. Makes sense. End of the summer. Last week we had a negative event move, and we yesterday at the end of the day we had a good sell-off that came back. So is the market just kind of getting ready to, have more of that difficult sideways action that we've seen? So what's the structure of that state? So where do things start to change? So one thing we want to look at is what we call our sentiment bias. So where is, that's the over/under number. So where is that? Well, that's way above the market. So that's something to consider. Okay, sentiment's way above the market. If we do, so that's basically identifies the upper peak of this neutral digestive state. So we also have what we call our critical range, upside pivot and downside pivot. So let's take a look and see where that's at. Again, these become basically your zones of value, where I want to bet more. And in the middle, you want to, you're not betting big in the middle, you're betting big when the market's in alignment. And then we're going to take a look at what's the optimal things to do today. Well, we want to fade moves at the extremes is the optimal thing. So, expectation is this is where the real energy is on the upside. This is where the real energy is on the downside. These are our optimal opportunities. We're definitely looking to participate in a, buying the market off of this area. It also looks like it's coming in, the top of that metric is coming in at the midpoint of the previous day. So this is good alignment. This is when we're talking about alignment. This is what we're looking for. We've got this quantitative market structure, and we have that is in alignment with the previous day's midpoint. So if the market's going to digest, we're looking for the market to stabilize above here, and we're looking for the market to reject here. So so on a hedge strategy theme, since we do have these parameters are pretty wide, the directional becomes a good rotational number. That's what this yellow line is. And here we have a strategy called a DIR breakout. So if we're going to do, a breakout is defined as a market that, really kind of starts out at one side of a metric boundary of market structure and moves to the opposite side. So at the start of the session, the market was holding the metric boundaries. It rallied above here, but then here it validates that it's truly below this level, and we're making a play for this downside pivot, this DP area. It can't do it, and then this is generating a breakout. Because you had the two alerts. It starts out, it's trading below this boundary, and now it's above. Here, this is more just kind of rotational. But now we have a clear breakout to the downside, move out of this range, and now we have a buy breakout, and it puts us in this theme here. So we're always identifying price action within market structure. And so so as a size management tool, absolutely this is our big size trade. If this is a 3-unit opportunity, and this is a 2-unit opportunity. And these interior structure points are smaller opportunities. So here, so now let's switch to, continue to go into kind of now the microstructure. Let's take a look at this. I don't have that history. Basically, this is your this is all the history I have on this one. This is what's occurring here. So size-wise, when we have when the market's breaking out of here, which matches up with here, we are getting some liquidity coming into the market. And size-wise, we know this is a 2-unit trade because we're trading within the metric boundary of a major price map level. So again, this is the 3-unit opportunity. These are the 2-unit opportunities. And these are the 1-unit opportunities. And this 1-unit opportunity kind of led into this bigger opportunity. So this could, this is a way that you can build on your size management. But this signal here targets here. So we're currently in this transitional, it's really a corrective rally. And the expectation is the market's trying to make a play for this level. It may get there, it may not. But we know it's a rally in a neutral digestive state. So we know we're not expecting it to follow through. This structure, we have an integration with Bookmap that we identify this structure here. So you get a sense of, you can really see what's happening. So we really can see what's happening within this area here. So now we have a new situation that's occurring. When you look at the bigger picture of where we're at, and the market is pressing into, we're right here. So we're not getting, this is not a time to get excited to the upside. This is a time to be careful with protecting your profits from the move that they've given you. Depending on your duration of the trades that you like to take, you do have some aggressive momentum. And even as a position management of a tool here and a size management tool, this for buying, this was the 2-unit trade. And so if you are pressing it, you're playing with fire, but the market should base above here, and it should be an add-on, and any add-on should be a 1 unit. But then on your size management as well, you can use the structure to manage your position. So if the market can't base above, basically 26,450 right now, and you can see some of the liquidity starting to build up off that metric, and then you can see this price structure here. Basically you need to define, if the market can't hold this structure, what will it do? It's more likely going to come back down to here. Do I want to give back that money? So if you came into the market here and you sold one out here, because you had two, you sold one out here, and then you sold another one out here, waiting for a potential reaction back down to this level, and you're not getting it, and you want to get back into one more, basically buying the market out, putting your risk here with your reward targeting here makes sense. But it's still just a 1 unit for your size management. Also, in terms of structure, as you move through the trading session and you go from your opening phase to your discovery to the validation and coming back into settlement phase, better opportunities absolutely for liquidity are going to occur during when the crypto is in alignment with the legacy markets. So basically just the times of when the S&Ps are active. Really kind of 7 a.m. till noon, 12 noon, 1 o'clock. After that, things start to shift. After 1:30, the markets are going to start to gear up for their settlement period, so things can get a little squirrely. So what that means also with structure is that the market has broken out here, so it gave you your signal, it paid you out, so it gave you money. If we do get follow through here and we make a move up here, this structure is going to change in the next period, which for Central Standard Time, that's 7 p.m. or 12 midnight UTC. What kind of opportunity follow through will I get? And fact is, more likely, if the market closed right now, closing meaning it was 12 a.m. UTC time, more likely the sentiment's going to shift. And the market state might shift as well. We don't know what that's going to be. But if it does shift, that could signal that the market's transitioning into a potentially positive transition, positive breakout. We don't know yet. But what's the potential for that area? So as the market comes up here, do we really want to load up? No, we don't, because we're coming in near the end of the period. So when you're thinking about your size management, you need to consider, does the market have time to follow through for my horizon? And with the daily structure, as the market moves past 2 o'clock, you need to consider that. What can it really accomplish? And because the legacy markets are going to close at 4 o'clock, and then we have another 3 hours before the crypto really settles. And most times than not, that's kind of choppy trading. So that needs to be considered. But if you don't have the bigger structure and you're just working with the microstructure, you're running into walls. How do you value a trade? It can't be subjective. But when you're combining and you have a bigger picture view, and you know that, hey, the market is above the previous day's high, and you do have some other structure where even just understanding where sentiment is for the day, and knowing that if the market goes above the previous day's high, where can it go? It can go try to make a play and test sentiment. Why? Well, the market is in a neutral digestion market state, and we're not expecting follow through. So if we do get a big surge, instead, you don't need to step in front of this, this momentum. Let the momentum tell you when it wants to stop. But as you're here, you're not getting caught up in buying into this when the market is looking to potentially exhaust. And so then when you get your exhaustive signal, that's when you hit it. And those signals are going to work, and those signals are more valuable the earlier they occur in the trading period. And they're only less valuable because based on the time frame you're trading, because structure is going to change and rotate, and that's going to change the whole picture of everything. And so that needs to be under consideration. So I invite everyone to come to our website, dharmacapital.trade. You can register for free, and there's some good content there. We do have a core strength assessment profile that you can take. That'll give you some great insight. It really helps with your intuitive trading, and your awareness. And the more you are aware of yourself, the more it's going to improve your trading. So we have an assessment tool. And if you do go through that and set up, you feel free to send us your score results, and we can kind of give you some guidance. Also, if you're interested in our integrations, our Bookmap integration, and our playbook, you can learn more about it on the website, and you can sign up from there. This size management is really the differential. So no matter what you take away from this, you need to break your trading up and your decisions up into units, and you can't just always come in and be here's my I'm doing max size today because I woke up happy or whatever, or I don't want to, I've got too many issues going on that I'm going to trade small today. That's not what trading's about. Trading, are the odds in your favor? What's more likely to occur? Is your trade in alignment with what's more likely to occur? If it is, you have to trade bigger. If you're dealt tens playing blackjack and there's no ace in your hand, you need to double down on that. And if you don't, everyone's going to look at you like, what are you doing? It's the same thing. You just have to, have yourself standardized to be in those situations. Like when this occurs, if this occurs, then I do this. And every trade it should be that. That should be the process. That's the size management should be the main process, the standardization of your trading. And it's a simple, straightforward thing to do, even to the tools I showed you with just using the time frame and using that as kind of a simple guidance, and you will see immediate impact that on your P&L. Immediate. It makes all the difference in the world. Well, I hope you guys follow through and come visit us, and next week we'll get into some more insight, and enjoy your days. Cheers.